Good evening, and thank you for joining today's webinar. I'm really happy to host yet another session as part of UB's Expert Take webinar series today. And this is an ongoing effort to keep our partners informed about key industry trends and issuers, helping you to stay ahead in the evolving financial landscape. I am personally excited to invite our special guest, Mr. Vineet Sukumar, today, and we will have Vineet talk us through the journey of Vivriti thus far, key milestones, key priorities, and a road ahead for Vivriti Group. Welcome, Vineet, and thanks so much for joining in here.
Thank you for having me.
So, just to talk through the agenda and what we're going to hear from Vineet. Vineet will walk us through Vivriti's perspective of the market, particularly as a mid-market focused NBFC, which is playing a crucial role in bridging the credit gap for the businesses. The players and stakeholders in this market are evolving rapidly amid changing economic conditions, regulatory shifts, and new opportunities in debt markets. Just a brief introduction about Vivriti Group. Vivriti Capital, an NBFC incorporated in 2017, dedicated to providing innovative debt solutions to mid-market and mid-sized enterprises across sectors like financial services, renewable energy, healthcare, infrastructure, and so on. Along with Vivriti Asset Management (VAM), a registered asset manager of fixed income alternative investment funds, launched in 2019, Vivriti Group is shaping the future of mid-market lending altogether. Again, I'm honored and we are honored to have Vineet Sukumar, promoter, founder, and CEO of Vivriti Group with us today. Vineet has over 20 years of experience in financial services and is an industry expert in debt capital markets, performing credits, financial inclusion, and digital fund management. Vineet has completed his education from IIT Kharagpur and IIM Bangalore. With that, I'll hand this over to Vineet to walk us through Vivriti Capital's journey, its future priorities, key strategic initiatives, and so on. After that, we'll open the floor for a Q&A session where we all can engage directly with Vineet and get his insights on topics relevant to us. Thanks so much, and over to you, Vineet.
Thank you, Irfan, for that great introduction. Just to stay organized, I will spend around 15 minutes in walking through a short slide deck that updates the December performance of the group. And post that, perhaps it'll be easier to take Q&A from everybody around the floor. So allow me a minute, please. So as Irfan outlined, when you think about Vivriti, it's important to kind of build a picture of the market that we are in, because we are a group like no other. And I do not say that frivolously. That's because when you think NBFC, you typically think housing finance or microfinance or personal loans or mortgage or LAP, etc. We are none of the above. We have a razor sharp focus on what we call mid-market. Mid-market is for us the upper end of MSME, where companies and well-run companies with a top line of anywhere between 100 crores to 2,000 crores seek to build growth, scale, viability, profitability, valuation in the corporate debt market, and that's where today we operate. Today, this market is an extremely rich market, which means that by terms of size, it is second largest, only second to home loans, right? The home loan market in India is roughly $350 billion, and the mid market is roughly $250 billion, right? And therefore, it's the second largest market by size and therefore promise. We were set up in 2017, so Vivriti is within kissing distance of completing 8 years of existence. We are a mid-market specialist. And why specialist? Because I firmly believe that specialization builds value in the long term. And therefore we have been having a razor sharp focus on how to build value in mid-market. We operate through two legal entities, Vivriti Capital and Vivriti Asset Management. Vivriti Capital is a non-bank finance company. We will spend a lot more time on Vivriti Capital's numbers in the minutes going ahead. And Vivriti Asset Management is a fixed income fund manager that sets up alternate investment funds that also provide debt to mid corporates. Right? It's been nearly 8 years since the day we started, and been a very, very rich, rewarding journey so far. We'll walk you through numbers. Here are where headline numbers stand as of the end of December for Vivriti Capital on a standalone basis. Assets under management of a little over 8,600 crores. Broadly, 9-month profitability of 160 crores. This number has grown by around 47% YOY between 9-month 2024 to 9-month 2025, right? Our net worth is well over 2,000 crores. As a company, we have more than 350 mid-market enterprise relationships, as well as 60 plus lenders who are lending to us on our balance sheet. We are leveraged modestly, so the capital adequacy of the company is quite controlled at north of 21%. Debt equity is around 3.3. And we enjoy an A plus credit rating from CRISIL, ICRA, and CARE Ratings, right? We have been quite fortunate to engage actively with some of the best investors on the planet when it comes to our debt. We were the first to issue a certified climate bond in the NBFC space. We have been very, very, very active in ensuring that our portfolio is extremely ESG positive. We have been engaging closely with large investors like Asian Development Bank, SIDBI, and many, many others. We completed our first public issue of 500 crores in August of 2023. And we followed it up with 2 issuances in December and January recently at the 10,000 face value issuance. This is a short history of the company with some of the key events that is laid out in front of you. I'll draw attention to a few. Our capital raise has been quite consistent. So in January 2019, in March 2020, in March and May 2022, and once again in November 2023, these were the 4 dates on which we raised equity, right? Put together, we have raised around 1,400 crores of private equity since the day we started, with our most recent investor being TVS Capital, a name that is probably very, very well known to all of you, right? We were rated A minus as our very first rating, which happened in January of 2020, and today we are rated A plus by 3 rating agencies. At that time, it was A minus by ICRA. Today, it's A plus by 3 rating agencies, CRISIL, ICRA, as well as CARE, right? By way of lending and investing, we have today built, as I said, an 8,500+ crores balance sheet. We've also been successful in raising liabilities of various kinds. Today, the longest tenor liability that Vivriti has raised is 10 years. And that is quite remarkable for a company at an A plus rating. We are not even AA or AAA yet. Moving on. Here is a sense of what our asset management company does very briefly. Raised over nearly 5,000 crores of commitment so far. Returned 1,200 crores to our clients with absolutely 0 delays. Actively invested and built a 3,500 crore portfolio. So if you look at Vivriti Group, 8,500 in the NBFC, 3,500 in the asset management company, cumulatively 12,000 crores of AUM managed by this group. We have, as I said, raised a considerable amount of capital so far from investors. Every investor has invested at least twice in our cap table. Creation thrice in Series A, B, and C. LGT's Light Rock Fund twice in Series B and C, and TVS Capital twice again in Series C and C2. Roughly around 22% of the company is owned by the promoter and the team, and 78% by shareholders. Right now, from a business model perspective, as I outlined, we focus on mid-market India. Right. Mid-market India today, as I said, is composed of corporates and NBFCs cutting across a vast number of sectors. As a group, we have ever lent to 470 companies, and we have around 350 as we stand in the portfolio, right? We have today built a highly granular balance sheet, and we'll come to that in some time. We'll walk you through the diversification statistics. But fundamentally, we have two kinds of products. One is B2B, where we directly lend to the enterprise. And the second is B2B2C, where we work with the enterprise, but fundamentally we are either co-lending to their retail borrowers or we are lending to their vendors and dealers, which is like a quasi retail exposure, right? So we have B2B products and we have B2B2C products. Our B2B products will be like loans, working capital, leasing, bill discounting, bonds, securitization, etc. Our B2B2C products will be vendor finance, dealer finance, factoring, as well as co-lending, retail co-lending, right? As a result, today, if I look at a balance sheet diversification, today our balance sheet today has well over 300 enterprise borrowers and more than 1 million retail borrowers, which makes it an extremely diverse balance sheet. This gives you a sense of the diversification at a sectoral perspective. The details are in front of you, but fundamentally we are operating in more than 50 plus sectors across the country and a very large number of clients as well, right? Here are some headline numbers. So the first graph on the top left is giving you a sense of profitability, ROA and ROE. So our headline ROA is today at close to 3%. Our ROEs are steadily climbing. This year will conclude at north of 12%. Our rating history has been consistent, A- to A to A+, and moving from one rating agency to three rating agencies. Our growth has been consistent. So from a profit perspective, last full year we were at 190. This year at 9 months, we're at 160 and we are at a 46-47% growth rate, and we should be able to have a very healthy growth rate for the year-end number. In terms of yields and NIMs, this is where again our business model comes in focus, because you are used to seeing retail NBFCs lending at 20%, 25%, 30%, 35%, etc. We are a 15% lender. And because we are a 15% lender, that gives you a sense of the safety of the portfolio, right? Similarly, our portfolio NIM stands at around nearly 7%, which is very healthy. From a growth perspective, we have consistently grown every year since the last several years. On the bottom right, you will actually hardly see a blip, and you probably won't even realize that in 2020 to 2022, we actually had COVID. But in that period, the company grew from 1,000 crores to 3,500 crores, right? Despite what we saw in the market. And this has not come by sacrificing asset quality. Today, our net NPA continues to be at 0.5%. This is a number we have consistently maintained with a 70-odd% provisioning coverage ratio, right? In terms of diversification of the book, as you can see, we are presenting this in two ways. One is to look at the top 5, top 10, top 20. That's the top left graph. You can see consistent reduction. So for example, top 20 is at 12.5%, top 5 is at 3.7%, right? Extremely granular. Ratings of the book, right? Diversified well across rating categories, including the A category as well, right? Top exposures to net worth. This is essentially top 20 exposures as a percent of net worth. As you can see, it is very comparable and in many cases better than banks, right? Even an HDFC, Kotak, ICICI, Axis would be better in between 85 to 120%. Vivriti stands at around 50% today, right? Pretty much very close to where the best of the banks are, right? From a risk perspective, very tightly managed. Today we have a completely digital early warning signal mechanism that allows us to constantly monitor portfolios at scale, deliver signals at a high frequency directly to the credit manager, allowing us to take quick decisions and safeguard our portfolio. Second, Every single company goes through an extremely detailed field diligence with credit and risk conducting the diligence, not the business team, right? And finally, from a coverage perspective, while we are well covered geographically across the country, but we also build a lot of risk sector expertise so that we are very clear about sectoral trends, sectoral cycles, sectoral pitfalls that we can encounter when we get into when we get into any single space in a company, right? Our asset life cycle has been managed very tightly through the entire life cycle of engagement with the company. So the risk underwriting framework gives us our rating model, our limits model, our tenure of lending model. So these three things go through a very an algorithm which gives us exactly what risk we are taking and therefore how much money we are allowed to give and for what tenure, right? The sectoral focus puts very clear portfolio controls in the portfolio, saying that we cannot go beyond a certain percentage to a sector, and that limits therefore how much risk we can take at either a sector or an entity level. Multi-level underwriting, what does that mean? That means that today we follow a combination of a desk and a field process. In the desk process, data plays a very significant role, right? Data sets from MCA, from GST, from PF, litigation, from bureau data, from ratings data, all coming together holistically with validations to be able to assess and restate the P&L balance sheet of a company, right? The field analysis, however, gives us a touch and feel of is the company's policy and process in line with what their reports are, right? So we spend a lot of time, 2 to 3 days in each case, in factories, in retail outlets, in project locations, in branches, as well as head office, ERP assessment, etc., to thoroughly understand a company, right? Data repository and analytics. As I mentioned, India is an extremely data-rich country, and we are extremely fortunate to be where we are today. Today, there are 9 public data sets that we can use. So that's the digital public infrastructure that's available for us. Part of it using consent, part of it without consent. This can this can allow us to redraw the P&L balance sheet cash flow, the receivables, payables, related party data, financial information, rating migration, as well as a very clear bureau assessment, right? It also allows us to map what can be the risk from the litigation history of the company, right? Finally, diversification. Coming back to the portfolio approach, very, very important for us to control top 5, top 10, top 20, and top 22 net worth as we build our business, right? Now, Vivriti Capital has been probably one of the most successful NBFCs in raising debt. And why does that matter? Because that allows us to maintain a very healthy ROE. The fact that we run a low risk portfolio, which is predominantly a rated book, a secured book, a low duration book, right? When I say rating, the weighted average rating of our portfolio is BBB, right? No other segment will have a rated portfolio, such as microfinance or MSME or housing, etc. Second, we run a senior secured book. We don't run an unsecured book, right? That gives us a lot more control on the promoters, right? Number 3, we run a low duration book. The duration of the book of Vivriti Capital is roughly 15 to 18 months, no more. It allows us to significantly exit positions very fast in case we see a challenge. Fourth, we run a highly diversified book. Now, these 4 things have ensured that lender interest in Vivriti has remained high, right? So today, for example, more than 40% of our total liability is not bank. That is quite unheard of for a company in our rating. It is very true for AA's and AAA's, but in A category, it's unheard of, right? Second, almost all banks in the country today are lenders to us. Number 3, we've tapped into bank market, into bond market, into ECB market, into DFI market, into the wealth market, into the retail market to raise debt, right? And as a result, have been very successful in diversifying our liabilities around the ecosystem. This will give you a sense of our lenders on the public sector, private banks, capital markets, etc. I'll pause for a second for you to absorb this data. Yeah. From a governance perspective, my board is very well diversified with three independent directors and an independent chairman of the board. My independent directors come in from backgrounds like HR, private equity, corporate lending, technology, etc. Our investors today all have representatives on the board. Finally, the management team is very senior and well placed to take us to the next level, right? Across operations, credit, treasury, financials, legal, business, credit, risk, data science, and sustainability, right? So a well laid out team with a stable top management. Most of these guys have been with me for the last 3 to 7 years and have built significant vintage in the organization. Equity capital, I covered this. That's it from my side in terms of a presentation. I'm going to stop sharing and pause the slides here. Would love to take questions and make this as participative as possible.
Thanks so much, Vineet. We had a few questions already before the session that our audience wanted to get your perspective about Vivriti and also some bit of prospects ahead. While the participants post in questions, uh, audience, you can post in the Q&A chat box, and then I can take the questions from there. While you do that, the questions that I already had from our audience, I'll pose it to Vineet. So, Vineet, one of the questions probably you touched upon that in the presentation. That was regarding some bit of when you say when some perspective about the road ahead for Vivriti. If you can share some bit of it on where would we see ourselves at Vivriti end of quarter 4 and FY 26 end. That was one, and then probably the road to a public markets debut. So when is that likely? So that was one question coming in, and then I can take other questions as we go along.
Sure. While we don't give a guidance in terms of financials and outcomes going forward, but broadly, the intention that the company has is to grow at roughly 30% CAGR on assets or AUM and roughly 40 to 45% CAGR on profits. When I say CAGR, I mean CAGR, compounded annual growth rate. So we would like to maintain for the next 3 to 5 years CAGR of 30% on AUM and approximately 40% on profits. How will that be done? One, by ensuring that we're able to go much deeper into the country. Today, Vivriti is already present in 9 physical locations across the country. That number will go to 15 fairly soon. The second is product development and constantly working on what our clients would like to see and what would be relevant to them. And thirdly, by ensuring that we are able to provide a lot of customized solutions, working closely with technology to be able to deliver products faster, underwrite faster, monitor faster, build a lot more process efficiency, right? What this gives us is a very clear line of sight of growth, right? One must remember that unlike many other lending markets like MSME, mortgage, consumer, etc., those are fiercely competitive markets with 50 to 100 incumbents. Whereas in my segment today, there are extremely few specialized players, right? And therefore, that gives us a long rope to grow, right? And as a result, we are able to see a clear line of sight of asset growth. Profit growth will come from the fact that we've consistently moved ahead in credit ratings. So a further improvement will continue to reduce our cost of funds, which will improve our profitability. Secondly, as we build scale, our operating efficiencies should keep building up, which will ensure that our profit growth rate is higher than our AUM growth rate, right? From a public market offering perspective, I think we're at least 3 odd years away, but difficult to say more than that.
Appreciate it. We have few questions we can take that we have in our chat box. So probably one for the first one was, what are the databases used by Vivriti apart from Perfios and CIBIL scores in our underwriting? Very good question. You want to take that, Vineet?
Yeah. So I think I can say it with high confidence that India has the best data stack for corporate lending that is across any emerging market and most developed markets. Let me outline what we have in much more detail. One, the Ministry of Corporate Affairs has full financials of every registered corporate, a full list of directors of the company, a full list of all lenders and their hypothecation and security arrangements with the company, right? There are credit bureaus that give the data of borrowing of both the company and the directors of the company, from which we can assess the credit worthiness of both. There are litigation databases. That means that NCLT, Supreme Court, High Court, and Municipal Court rulings and live cases against a company can be downloaded and assessed to see where the risk lies. There are bank statements, digitized bank statements, and digitized GST statements.
Yeah.
So GST gives us invoicing, which means I can draw up the accrual P&L of revenue and expenses. Bank statement gives me cash, which gives me cash flow. The difference between the two gives me the receivable position and the payable position, right? We also have something called the Provident Fund database that actually gives us how many employees are there in a company, and is the company paying Provident Fund on time? And if not, that gives the sense that there is a liquidity challenge in the company. Finally, like I said, India has had, I didn't mention this, but important to mention, India has had the deepest credit rating coverage across most countries I've seen, right? More than 50,000 enterprises have been rated, right? And that gives us a deep rating analysis going back several years, right? So bank statements, GST, Provident Fund, MCA, Credit Bureau, litigation, Provident Fund data, credit ratings, all of this is available. In addition, there is also information on the sector. So commodity prices, exchange rates, right? Movement of money, interest rates, and what that will have as an impact on the company that we are engaging with, that's also available. So the role of fintech can be fantastic if run well, and we are investing quite heavily.
Probably clubbing, there are many questions that are coming in. I'll probably club more on themes that we have. One is more macro in terms of the key growth drivers for NBFCs in India, especially going ahead in the upcoming financial year, more from an NBFC sector's perspective. And also a take on the subsectors or asset classes like NBFC as an asset class, further MFIs as a sub asset class within that is a larger question. And there is also a specific probably question regarding Vivriti, Vineet. It is about the cost of debt. There seems to be trending upwards even after credit enhancement. I don't know what credit enhancement here means. It probably credit rating or something, but you can touch upon the cost of debt here from Vivriti's perspective.
Sure. So let's take the cost of debt. That's an easy one. We can
Sure.
quickly cover that and move to the sectoral question. Our cost of debt has probably moved up by around 25 to 30 basis points in an environment where RBI and banks increased rates by 250 basis points. So as we all know, before the recent rate reduction, repo had gone up by between 225 to 250 basis points. And although there was a lag, but the MCLR, which is the floating rate benchmark of banks, also went up by roughly 250 basis points, right? And by the way, that has not come down at all. Even though RBI has cut repo, no bank has cut MCLR, right? So therefore, the situation we have faced is a very, very, very tough situation. And we actually had to maintain our borrowing costs within a very tightly managed band, despite market rates going so high. So yes, there's been a slight increase, but the increase in our borrowing cost has been possibly 1/10 of what the market has seen, right? Now, let's come to the other question, which is on the sectoral situation. Now, NBFC as a space has gone through lots of challenges in the last 12 months, and like what happened after 2018, it is very clear that liabilities are as important as assets, if not more important, right? Now, very clearly, with RBI seeking to delink banks from NBFC contagion, right? There has been a dearth in terms of bank credit availability for NBFCs, and this has hit the entire sector, and even more so to companies where they had high dependence on banking credit, right? In Vivriti's case, in the same period, we also saw a rating upgrade, right, to A plus. And as a result, even though the market was generally negative on NBFCs, we still could benefit and continue to raise money. Secondly, we've always had a focus on liability diversification. I showed you that in the slides. And therefore, we activated capital markets, we activated the climate bond, we activated a long-term 10-year borrowing from IRIDA, etc., 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 to be able to ensure that our dependence on the banking space was as low as possible, right? Uh, the other part that I think has generally benefited us is that, yes, there has been a lot of concern on microfinance and unsecured business loans and unsecured consumer loans in the market. And these spaces have seen either a flat to degrowth for most players from March 2024 till December 24, right? But in our case, we are frankly neither lending at high rates. We are 15% lender, nor are we lending to retail. We are a focused corporate player, right? And nor are we impacted by concerns around unsecured lending, because what Vivriti lends is secured, right? So we are actually in a good spot. And I think that the markets have come to realize that a business model like ours is actually a very good hedge and a very stable hedge against whatever they are seeing in the market so far for NBFCs, right? Having said that, I think my belief is that we have seen now 9+ months of deleveraging at a household level, and probably another 3 months of that, and we should be through with the current asset quality crisis that the unsecured lending models are facing. Doesn't impact us, but at the end of the day, it's good if the market is also generally back on track, and we expect that to happen by end Q1, early Q2 of next financial year.
Yeah, you touched upon the growth drivers for 25-26. Probably I'm clubbing it with the other two questions that came in with it. Growth drivers for NBFC as a sector for 25-26. And there is an open-ended question which is to do with if there was unlimited capital and regulatory freedom, what changes would we implement in our NBFC to create that impact? Open-ended. But I think the other question is probably, I'll take it probably in this only, throwing more light on how technology is being used at Vivriti while monitoring exposure. So I'm just trying to club all three in terms of outlook for 25-26 in terms of growth and technology, and then with capital constraints taken away, how would we go for creating more impact?
Okay. I think with continued overhang on unsecured lending balance sheets, we will see a fairly slow growth in the NBFC sector in the next financial year, in 25-26.
Sure.
And that's because, again, liabilities will play out even more than assets. And therefore, balance sheets should be facing a slightly muted growth in the coming year, which is fine because I think asset quality will improve sharply as a result. And we should also see a fair amount of provision rollback, right? What we typically see when we see a down cycle in the NBFCs is that people take significant write-offs and provisions to make sure that the balance sheet reflects the current picture. But later on, they actually start collecting against write-offs,
Mm.
right? So always in the year following the cycle, we see a sharp uptick in profits, which is non-linear, right? Very recently, we saw that happening in SBI's own earnings with a bumper profit growth in the last quarter, right? So I think next year will be probably slower growth on the AUM side, but a much faster growth on profitability, which is, I think, fine for us from a lender's perspective, right? From our own perspective, I think next year should be good. Again, like I said, we would prefer to keep a very steady growth curve for us. And given the nature of our business, I think accessing liabilities and capital will not be a challenge. Uh, from the perspective of technology and the role technology will play, as I said, an area we're investing heavily. In monitoring specifically, we are seeing a massive application of Gen AI, because Gen AI will give us the ability to not just absorb any data set from any client and convert it to our format, digitize it, move it to our document management system, then create analytical outputs, bring that into our diligence report along with auto writing, right? All this is within reach. And we are closely working with specialists in the field to be able to achieve these outcomes for ourselves, right? What does that do? What this means is that therefore, tomorrow, if I need to monitor a company and I insist that the company should share data with me monthly or quarterly, right? If I did not do all this tech investment, I would have to keep adding bodies in the room, and our
Yeah.
OpEx would never improve, right? But with fairly modest Gen AI investment, we are able to see a dramatic change in efficiencies, right? That can change caseload. It can also make sure that our team is focused on what's important. They're not just transcribing information, but analyzing and using their analytical skills to make sure that we're in a better position to uh, deliver on the right asset quality of our portfolio, right? So significant investments in this segment is expected in the next 6 months, 9 months, 12 months, and going ahead as well. If I had unlimited capital and regulatory freedom, what would I do? I think I love that question. And it's a wish list, uh, wish list for us of things that we would do in terms of, the kind of capital providers we would go after, or the kind of dense network that I would build across the country to be able to acquire high quality corporates and get them to know us better. There would be also significant ramp up in technology investment, because right from product delivery to Gen AI to managing very large data sets, I think there's a lot more that we can do, and therefore I would really invest more in our technology infrastructure to make that happen. That's the future for us. And finally, potentially start thinking about an international expansion, right? That's of course a bit of a blue sky, but it was a blue sky question.
I'm sure. One piece that came in, I was waiting a lot of optimism here in terms of growth and everything. But from reality check perspective, what are the challenges that Vivriti is planning for, that we see ahead, or risks, especially in the upcoming years, etc. There are obviously opportunities that you touched upon, places of investments that Vivriti is planning, including technology, risk management, so on and so forth, that you talked about. But challenges slash risks that we foresee and then we are planning for.
So let's touch upon the two elephants in the room, which are the two big macro items. The first big macro item is US-India relations that results in all kinds of tariffs across corporate India, which results in potential disruption of services, disruption of supply chains, cost escalations, uncertainty in terms of economic growth, um, entrepreneurs postponing capex until they know what is happening. All that might happen because of what's happening in the economy, and because we are a mid-market lender, naturally we will have both current clients and prospective clients who are affected by this. The second big macro issue is regulatory action or activism. which has been very, very significant in the last, say, 24 months across banks, cooperative banks, NBFCs, fintechs, etc. And likely to continue for some more time because there is consistent need to get many things right and build parity between banking regulation and non-bank regulation. So these are the two macro areas that we have to be very watchful about and ensure that from a governance, compliance, as well as reporting, as well as regulatory engagement, we are top of the line as compared to anything else. Similarly, from a portfolio or sector selection, we avoid sectors and companies which have a significant US exposure, or in fact, any export exposure, and rather focus on companies which are looking inwards into the big Indian consumption growth story, right? The second category of risk is risk management, where till date we've had a fantastic run in terms of building a high quality book, but that can change because at the end of the day, sectors can go through cycles and we can get impacted, right? What's our hedge against it? Our hedge against it is to lend secured. Our hedge against it is aligning the promoter through promoter guarantees. Our hedge against it is a low duration book. So if we don't like a sector, then at least in 10, 12 months, I can be out completely because duration is low. So these are the ways by which we can risk manage and actively risk manage the book, right? The third category of risk is availability of liabilities and capital, right? Given that the RBI's efforts towards delinking banks and NBFCs have not come off, so to speak, right? Therefore, banking access will remain a challenge for the NBFC market for some time. What's our hedge against it, right? Is to raise capital and upgrade to a AA category.
Sure.
Right? And the moment we do that, access to capital should very significantly change for us as an organization because risk weight comes down, banking limits open up, etc., etc., etc. So these are the three categories. There is macro, there is risk management, and there is liabilities.
You touched upon the liabilities, and there is a related question that has come in, and can help with your perspective. Can you shed some light on market infrastructure within debt market in India, and how do things from right from origination to distribution of NCDs to investors, the infrastructure there, and various institutions involved, platforms, etc.
Sure. Although I think you are probably better qualified to answer this than I am, but I'll take a shot and worry to add as well.
Sure.
So I've been involved in debt market now for 20 odd years, and I think probably spent a lot of time on both SEBI and RBI committees speaking about how to open the junk bond market, how to deepen debt markets, how to build participation in debt markets, etc., etc. We went through a phase between 2013 and 18 where you saw a lot of mutual funds come into A category as well. And we started seeing the emergence of the triple B bond market and so on. But from 2018, once Ireland FS defaulted, a lot of that got pulled back, right?
Yeah.
And between 2019 to 2022, till COVID ended, 96% of issuances in bond market was only AA, AAA. Now, in the last 18, 24 months, there have been dramatic and remarkable changes. The first is the deepening of the issuer market. Today, in the last 2 years, the volume of issuance in A and BBB and unrated has gone up by 2.5 times to 3 times. Number one. Number two is the emergence of regulated intermediaries, so online bond platforms, brokers, merchant bankers, etc. A lot of formalization has happened in the space backed by private equity, which has resulted in investor having real options, right? Which can be as easy as downloading an app and deciding on which instrument to buy, right? Not only are there more intermediaries, but these are now much better integrated with the exchange, which means you can have a fantastic user experience. You don't need to log into multiple platforms. You don't need to have a fulfillment challenge. You don't need to have an information asymmetry between X and Y. And many things have been solved by such platforms, right? And finally, there has also been an emergence of platforms that can aggregate risk and give you a diversified portfolio, right? Which could be bond basket, it could be a PMS, it could be an alternate investment fund operating under the SEBI regulations. And these are mostly regulated platforms, right? So in summary, I think the last 2 years have been remarkable. I think financialization of domestic savings is a reality. While a lot of that may have gone into equity in the last 2 years, but it will flow into debt as well. It has as well. And therefore, the lower end of the bond market has doubled to tripled in value and volume. The emergence of regulated platforms, regulated intermediaries, regulated aggregators and asset managers has really built a lot of value to investors to be able to build very stable fixed income portfolios, right? So I'm very encouraged. I think it's now become a unstoppable wave, and it will only end with the emergence of a very deep and liquid junk bond market, very much like the US.
Yeah, I completely agree, and probably our own perspective at Aspero, given that we are an OBVP stockbroker debt ourselves. Uh, the entire infrastructure, in fact, driven by SEBI, has been really remarkable. Especially that the OBPPs can now, with the integrations with BSE, NSE, and the exchange settlement and RFQ reporting, and obviously this ensures the entire trade reporting to settlement is seamless. And RFQ is another way or the infrastructure that is set up really well. That should give significant confidence to the investor out there. And this is a retail investor and not an institutional investor. And encouraging thing that we have seen is a retail individual investor investing through an app of the in the NCDs issued by an NBFC that or sorry an issuer who is rated AA minus A triple B and on the listed NCDs. So I think the numbers are also coming in, Vineet, and especially the wave that you talked about. We are seeing every month there is a significant uptick, and then we are extremely excited about being an online bond platform ourselves and being in this space. Yes, the entire ecosystem is coming together, right from brokers to merchant bankers to many other players contributing their way, and then SEBI doing its bit, bringing down the face value from 10 lakhs to 1 lakh, and now an online bond platform can host a 10K issuance, face value issuance as well. We already had 1000 face value through a public issuance. So all this I think is coming together really well. Yes, with more disclosures and more investor protection mechanism coming in, in this ecosystem, this is bound to grow. Yeah, I think we are directionally headed the right in the right manner only. So great. I think one last question probably, because we have about 7 minutes, and one question that came in, Vineet, is regarding Vivriti again. How is the sector weightages in the portfolio, like in the underlying lending portfolio? How is the diversification across sectors? I think the attendee is trying to ask the sector weightages and in the underlying portfolio from a diversification perspective.
At the end of the day, one must remember that we are just 8 years old, although our numbers are a bit ahead of ourselves, but steadily moving towards a balance sheet where we have a 50% weightage on COP and 50% weightage on financial institutions, right? This is typically what you see in any bank in the country, and that's where our aspiration is. Within that, we will have close to 65, 70 sectors. That's the target that we're aiming towards, so that we are not overly exposed to any single sector in the country. And within that, we ensure that the single entity exposure comes down to as low as 5 basis points as we scale over the next 3 years, right? So make it very, very granular and endeavor to retailize enterprise lending.
Perfect. And that's really good for a 7-year-old entity, and as a group, 12K AUM, and these are the numbers, really encouraging. So we may probably end that, Vineet, if you have any concluding remarks on Vivriti or whatever we've just talked about, and then we can end after that.
Sure. Okay. So as a conclusion, what I would like to say is that look upon us as a mid-market specialist. In the NBFC sector, the NBFCs that add value are the ones that bring in deep specialization and therefore build their organization around the customer, right? So our customer is a mid-market. When you've seen the NBFC space, the companies you will remember are companies like Credit Access Grameen, Five Star, SK, Aptus, etc., who are deep specialists, or in the larger case, HDFC, Bajaj, and the likes, who have been winners and deep specialists in the segment that they built, because they tailored the entire organization, be it credit, process, business, acquisition, technology, around the customer. And that's what we're attempting. Our ambition is to be, as well known and hopefully as large for mid-market as perhaps Bajaj is for consumer, and that's the ambition that we're going with over the next decade or so. And I think the retail market in terms of liabilities will remain a very, very, very important part of that, which means continued issuances, continued price discovery, continued support for secondaries as well will be a key part of our liability evolving.
Thanks so much, Vineet, again for joining in, and then many, many congratulations for posting in those numbers for Q3. And thanks for taking our audience through the entire journey, and also how Vivriti is so sweetly positioned, even in this kind of context, trying to capture the opportunity that is coming through the corporates and mid markets as a clear opportunity. Clearly, Vivriti stands is in the pole position to be able to capture that kind of opportunity. And thanks for also talking through, the larger macro things, including the NBFC, emerging trends there, and then the opportunities as well as the risks and challenges ahead that we need to be watching out for. Thanks again, Vineet, for joining in. Our audience, I'm sure, would have benefited from your insightful discussion here.
Thank you. Thanks for hosting me, and take care.
Yeah. Thanks, everyone. Good evening.